So this lesson is going to be on order blocks. It's one type of institutional reference points or premium to discount array that we can engage entries from, okay, when traded too. So first of all, let's look at the bullish order block. The bullish order block is the last down close candle or consecutive down close candles before an impulsive move that break market structure. So it can be just one bearish candle, then when we violate it and break structure up, it becomes our order block, or it can be 2 or 3 down close candles or consecutive down close candles. And as we violate those down close candles and break structure higher, that becomes our bullish order block. Okay, I say that it signals a change in state of delivery and smart money buying. Okay, characteristics of a good or a strong order block: it should take liquidity. Okay, for instance, it sweeps a previous low and then breaks structure higher. Okay, so it should have a break of structure and it should have an imbalance or a fair value gap. For entry, you may want to enter from the open of the order block or the 50% of the order block, which is also known as the main threshold. Let's look at some chart examples. Okay, so you can see that from this bearish candle's high to this bearish candle's low, price was moving down. And then at this point, smart money decided to move price higher, violating this bearish candle's high and then also breaking market structure. It also took liquidity below this low slightly, just some 1 pip below. It went below this low 1 pip, so it swept that low. Not a significant sweep, but it still took liquidity below this low 1 to 2 pips. Break of structure, and it left what behind? It left imbalances. And from this candle's high to this candle's low, in between is a fair value gap. So that's an imbalance. Another imbalance here, this candle's high to this candle's low, fair value gap. So it left imbalances behind. It broke structure aggressively up. It swept liquidity below. Okay, so these two candles, down close candles, are your bullish order block. Okay, for entry, 50%. If you take your Fibonacci and measure from the bearish candle's high to the this bearish candle's low, 50% of that level is your mean threshold, and then you can see that smart money buys from that level. Okay, so if you're looking to enter, that's where you're going to buy. Your stop loss is just below this candle, and that's it. You can also take entry from the opening of the first candle. Stop loss below this low as well. For this example, you can see that here the delivery was to the downside, and then from this point, smart money changed the state of delivery, violating these down close candles, these 3 bearish candles, and also breaking market structure higher. It left behind an imbalance or a fair value gap. Okay, this candle's high to this candle's low. This little space in between is your imbalance or fair value gap. You also swept liquidity. So all 3 characteristics of a good order block is checked: a sweep of liquidity, a break of structure, imbalances. And price pulls back to the 50% of the entire order block. You can take entry from there, and you can see that smart money buys. And as I said, order blocks are smart money footprints. You know that smart money moves the market. It's either the algorithm is moving the market, or smart money, that's the big institutions or the central banks moving the market. So when smart money is moving the market, they leave behind these order blocks with aggressive move up, breaking of structure, and prior to that, liquidity sweep. So as price come back to the area 50% or the open, we want to buy as smart money is also buying. Our stop loss is just below the order block. Okay, one more example for a bullish order block. In this case, we don't have a sweep of a previous low, but we have the break of structure and we have our imbalance. Okay, so it's okay. The most important thing is narrative. If you are right about the direction of price, it's okay if you have just 2 characteristics being checked, you can still take your entry. So break of structure with impulse, fair value gap left behind, this candle's high to this candle's low, that gap in between is your fair value gap or imbalance. Price trades to the open of the bullish order block, this down close candle before the break of structure is your bullish order block. Price trades to the open and smart money buys. That's where you can engage price. So sometimes price may come to the 50%, sometimes it may just buy from the open. Okay, and as I said, order block sometimes it may be just one candle, sometimes maybe 2 or 3. If this candle was to be a bearish candle as well, then your order block will start from this candle to this candle, this 3 candle. But you can see here was bearish, the delivery was bearish here, the delivery was bullish here, and here the delivery was bearish. So this is the last change of state of delivery. So as we validate this candle high to break structure, this becomes our bullish order block. Okay, and then smart money buys. Now let's look at a bearish order block. It is the last up close. So for a bullish order block, it was the last down close candle or bearish candle before a break of structure higher. But for a bearish order block, it is the last up close candle or consecutive up close candles before an impulsive move that break market structure. I say it signals a change instead of delivery and smart money selling. If smart money is selling, we want to also be selling because they are moving price and you want to engage the market with them. Okay, characteristics of a strong order block, as explained early on, it should take liquidity, break structure, and have imbalance. 2 of these can be present and it still be a good zone to work with. Okay, entry open of the order block or the 50%, that's the mean threshold. Let's look at some chart examples. So here we have a break of structure right here with this impulsive candle. We have an imbalance between this candle's low and this candle's high. We didn't get any liquidity sweep, but 2 of the characteristics is present. Break of structure, imbalance, price trades to the mean threshold, the 50% of the bearish order block. So in this case, our bearish order block is just this candle, just one candle before the change of state of delivery. Okay, if all of these 3 candles were to be bullish, then the bearish order block would have been these 3 candles. But since here the delivery changed and then it changed again here, this is our only bearish order block. So 50% for entry and you are good. The open as well can be an entry and you are good. Stop loss is just above here. You take your profit down here and that's it. So break of structure with impulsive candle, imbalance in between here, and that's it. A good order block to work with. Another example, you can see that we swept these highs, this candle high and this candle high. They made equal high. Now I'll talk about liquidity, but I want you to know that equal highs, liquidity rests above equal highs and equal lows. So for this candle high and this candle high making equal highs, liquidity is resting there. Okay, support and resistance traders on the lower time frame are selling from there with their stop loss here. So smart money takes them out on this wick and breaks structure lower, leaving behind this huge imbalance of fair value gap. So now these 3 up close candles, you see that they are bullish candles, 3 candles bullish in a row before the change in state of delivery. So once we violate this candle and break structure, these 3 candles becomes our bearish order block. Measuring our Fibonacci from this candle's low to this candle's high, the 50% is the mean threshold. You can take your entry right from there and sell. You can see that smart money sells from that level. You can also sell from the open of this candle and you are good. Your stop loss is just above the bearish order block. Okay, just above that. So you see how smart money add more sales to their position and move price lower. Okay, one more example, a sweep of this high, stop losses of retailers who are trading support and resistance. They have been taken out by smart money. Smart money then change the state of delivery, break structure lower, leave imbalances behind. You see, imbalances behind. Now these 2 up close candles, they are your bearish order block. So for entry, you can take 50% of this entire level, this entire box 50%, but I see that in this case price didn't come to the 50%. It just used the first candle. So as I said, you can always take your entry from the opening of the order block or 50%, because it's not always that the price will go to the 50% or the mean threshold. So in this case, price smart money just decided to use the first candle, and then they sold aggressively from there. So if you took your entry from here, your stop loss is just above the high of the order block, and you take profits lower. Okay, how to use order block? Now you have to identify your higher time frame trend or bias. So before you even think about order blocks, bias is the most important thing to think of. Okay, your narrative is the most important thing. Where would price most likely trade to on the higher time frame? Are we bullish or are we bearish? If you are bearish on a higher time frame, we want to be looking for sales. And where are you going to sell from? You're going to sell from bearish order blocks on 4 hour, on 1 hour, on the daily as well. If you are bullish on the daily, you want to be buying. Where are you going to buy from? You're going to be buying from the daily bullish order blocks, 4 hour bullish order blocks, and 1 hour bullish order blocks, and even 15 minutes bullish order blocks. So what I'm going to do is, if you are bullish on the daily, we wait for a daily order block to be traded to, or we wait for a 4 hour or a 1 hour order block to be traded to. And when the order block is traded to, you go to a lower time frame. And what do you do there on the lower time frame? We look for a break of structure. We look for the same thing to repeat, okay, on a lower time frame, and then we take our entry. I'll give you an example soon. So let's say we are bearish on the daily, and price pulls back to a daily bearish order block. Now we are not just going to sell right away from the daily bearish order block, but when price gets to the daily bearish order block, we are going to wait and watch the 1 hour time frame. And on the 1 hour time frame, we are going to wait for what? A change of character or a market structure shift, okay, to confirm that the daily bearish order block would move price down. So when we get the market structure shift or the change of character on the 1 hour, the 1 hour will give a new bearish order block, okay, and that's where we are going to what? Sell from. Let me give you an illustration. So daily is bearish. There's a break of structure on the daily. We have a daily bearish order block resting here. Price pulls back all the way to the daily bearish order block. As soon as price pulls back to the daily bearish order block, we go down to the 1 hour and wait patiently to see what happens. As I said, price is fractal. Whatever happened on the daily would repeat on a lower time frame. So on the 1 hour, we wait for the same thing to repeat. A sweep of this high and a break lower, leaving fair value gap behind and leaving an order block behind. So as the 1 hour sweep this high, break structure down and leave behind a 1 hour order block, that's where we sell from, and we place our stop loss above this 1 hour high. Our first take profit is at this 1 hour low. Our second take profit is at this daily low. As simple as that. Okay, so the daily is bearish. We've traded to a daily bearish order block. We go to 1 hour time frame. We wait for a chalk for sell confirmation, and we sell from the 1 hour bearish order block with stop loss above the 1 hour bearish order block. And we take profit here, we take profit here. Okay, so the time frame metrics, if you are bearish on the daily and price trades to a daily order block, you wanna wait for 1 hour confirmation for entry, like I showed you. This is why we call confirmation entry. Okay, if you are bearish on the 4 hour and price trades to a 4 hour bearish order block, you go to 15 minutes and you wait for 15 minutes confirmation for entry. If you are bearish, or let's say we are bullish on 1 hour, price trades to a 1 hour bullish order block, you wait for 5 minutes bullish confirmation and you buy from the new 5 minutes bullish order block. Okay, so you don't just enter straight from these areas. You wait for lower time frame, change of character or market structure shift, and then you enter from the lower time frame order block that is provided. So for your assignment, I want you to go back to old data, look at 4 hour bearish and bullish order blocks that has been traded to, and check lower time frame to see what happened and how the reaction was before it moved away, okay, and how you could have entered.